Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Jason Blackwell, chief investment strategist at the Colony Group, to discuss the market's reaction to the CPI data just released this morning, and we'll take a look at the housing market as well. Jason, it's great to have you with us. Welcome to TradeTalks.
Thanks for having me, Jill.
All right, and we came in with the CPI reading a touch higher, both on core and total. What are your thoughts around it? It seems as if the market had a relatively muted reaction.
Yeah, I think overall it came in pretty close to expectations. I mean, you start to do some rounding errors in there. You know, you're talking 0.3% versus 0.2 on core. Pretty much right on target on headline. In our view, those year-over-year numbers are less important. 50% of that is telling us about what month rolled off versus what the current conditions are. Overall, that path of lower highs and lower lows seems to be intact.
So when you think about the Fed strategy going forward, of course, we have a rate decision coming out next week. Do you think that they're going to continue on the path that they have now, perhaps another hike? I mean, it doesn't seem to be that anyone's pricing in a cut for this year.
Yeah, I think cuts for this year are probably off the table. Our view has been that we've shifted from what we were calling catch-up mode to calibration mode, and so whether the Fed moves another 25 basis points from here, we don't think really rattles the market all that much. It's more about what that path downward looks like in 24, 25. Overall, our view is this. This particular print probably doesn't change anybody's decision for the September meeting. It's possible Powell comes out a little more hawkish when talking about November, but we don't think this changes anything for next week.
Because it feels like, in my mind anyway, that inflation still feels very sticky. I mean, energy prices, you see where they are right now. I live in New Jersey, and it's well over $4 to get a gallon of gas, and rents continue to be high. You're feeling it at the food stores. It feels like it's still very sticky at this point.
I think it's important to start to break apart some of these pieces. Goods inflation, actually, interestingly, is basically flat year over year, about 0.2% since last year. Where we're seeing that real stickiness is in the services sector, and a lot of that is housing and shelter. Importantly, that's a pretty lagged indicator. We look at housing prices. Basically flat year over year. We've not seen a whole lot of housing price growth in 2023. On the flip side, we're looking at shelter inflation, what the government's telling us, of up 7.3%.
Well, let's talk about the housing market overall. We know price, I mean, while it's flat year over year, they're still at higher level as compared to pre-pandemic. And part of that is due to supply. There's just not as much moving on the market, with so many folks already locked in, sub 4, 5%. I mean, unless you have to move, why would you go for a mortgage that's over 7 when you're locked in under 4? It feels as if until rates start to come down, even just a touch, there's that stalemate that's in the housing market.
No, it's true. It's one of the paradoxes that I think the Fed has put themselves in. Is on one hand, they're trying to combat inflation through interest rates. On the other hand, the biggest component, they're actually reducing supply. And so I think that dynamic probably does continue through the next year. I mean, one of the things I think a lot of people have been waiting for is recession. They've been waiting for a big growth hit from these higher interest rates. And the fact of the matter is, consumers and businesses just haven't had to access the debt markets since 2021. Everybody refinanced, everybody locked in those low rates, and so they're not having to pay these higher rates.
So, as you look towards the end of the year, Jason, at the Colony Group, what are your thoughts? I mean, even in terms of client positioning, what sectors look most attractive? Where what assets do you think are most attractive, at least through the end of the year?
One of the areas that we've really been building up positions in is fixed income. I mean, this is an area that paid very little for 10 to 15 years, and we think that math has really changed. And while a lot of investors are really juiced up on those really short-term Treasury yields greater than 5%, we think there's a lot of attractiveness in the 10-year over 4, and looking at corporate bonds and municipal bonds where we can get a little bit more credit spread as well. On equities, we think that's less interest rate dependent from here. The Fed probably doesn't have as much of a role to play. And more what we're looking for is just a broadening out of the market, looking at some of those small and mid cap names, looking internationally for winners beyond the Magnificent Seven that we've all become very familiar with.
Mm-hmm. All right, Jason, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.